This video is a continuation of the first video. In the first video we saw what are yield curves, or why and how interest rates are important, how we should be knowing, why we should be knowing them. Now in this video what we will see is on each of these dates, this is all data from the Indian economy, on each of these dates what was the shape of the term structure of interest rates, and therefore was there anything which we could have seen in advance. So sort of economic forecasting. Is it always accurate? Not necessarily. But is it always inaccurate? Not necessarily. It's a good data point, it's a good leading indicator, we can use it. So let us start with the first date which we have got here, and that is 5 June 2008. Now on 5th June 2008 we have a yellow line, and if we can see here, this is that yellow line, it is at 8%. So how do we read it? 0.5 years 8%, which means the bond issued by the government of India which has a residual maturity of 0.5 years. It may be a 30-year bond for all you know, but today onwards it is going to mature in the next 0.5 years or half year. So that is how we read it. So for a 0.5 year government bond, as on 5th June 2008, the market was happy receiving an 8% yield. Now we must also understand that this 8% is not on half year, that means it is not 16% per annum. It is a way of expressing, so it is annualized. We must have this clarification. So half year bond, government of India bond, 0.5 years has 8% YTM. 5 year paper also 8%, 10, 15, 20 also you can see this is a horizontal line very close to the 8%. Now how does one interpret this? Let's say you have 100 rupees, because there are economic implications, therefore we need to ask the question, what is this yield curve telling me? Let's say you as an investor, you have 100 rupees with you. If you invest for a period of half years, you are getting 8%. If you invest for a period of 20 years, even then you are getting 8%. So obviously an investor will say, whether I invest for the short term or whether I invest for the long term, if in both cases I am getting 8%, why should I block my money for 20 years? And therefore, now when we are talking of yield curves, there are some theories about it, preferred habitat theory, liquidity preference theory. So what we are talking about here is, let's say for example, liquidity preference, sort of. If I am getting 8% for 0.5 years, why should I invest for 20 years and still get the same yield? I might as well invest for half a year. At least after half a year, once the bond is, once the 0.5 years are over, I still have the chance again to decide whether I want to invest for another 0.5 years or whatever. So therefore, such a structure is known as a flat yield curve. There is nothing to explain over here, it is flat. So therefore, this yellow line is known as a flat yield curve, which we saw in June 2008. So what are the economic implications of that? Let's look at it from the bank's point of view. When does a bank make money? A bank makes money when it borrows cheap and lends dear. So a bank would like to borrow at 4% and a bank would like to lend at 7 or 8%, and the difference is the interest differential, is the earning for the bank. Now in this case, for the short term, bank is borrowing also at 8%, for the long term it is earning also 8%. There is no incentive for the bank to do great business under such economic conditions. Look at it from the investor point of view. Why will I invest for 20 years when I am getting the same interest rate for half year? Look at it from the borrower point of view. When a borrower wants, let's say, to have a big capital expenditure, and he wants a 10-year loan or a longish type of a loan, there will be a big mismatch, because all investors would have put their money in the short term of the bank. the bank itself is pretty unwilling to go all out and give loans. So therefore, whenever we have a flat yield curve type of a scenario, the conclusion which we can make is the economy is not going places. The economy is sort of generally just moving along, trudging along, not exactly stagnated, but something like that. This is not the best thing for the economy to happen. So a flat yield curve is not something which investors or borrowers would be really looking forward to, and many times it can be said, now this is the next part, many times it can be said that a flat yield curve is a harbinger of economic recession / slowdown. So therefore, when we see a flat yield curve, we can have one thought that are we heading into a slowdown type of a scenario. And why this happens, we have just now seen, because banks are not keen to borrow, lenders are not keen to give money for long term, borrowers don't find great economic activity, so they won't do heavy capital expenditures, all sorts of things, I mean. So therefore, this is what was seen in June 2008. The economy probably was heading into a sort of a slowdown. Now what happened after that? 17th July 2008, just 1 month after that, June 2008 and July 2008, just in a period of 1 month, the yellow line becomes the pink line. The yield curve, now we have to understand, when we talk about yield curves, there are two types of movements. One is the movement of the yield curve, whether it goes down, whether it goes up, this one. And second is the shape of the yield curve. The yellow yield curve was a flat one, and the pink one, we can say the pink one is an inverted yield curve. This part is very clearly visible that if you invest for the short term, you are getting 10%, whereas if you invest for 5 years, you are getting close to 9%. This sounds illogical, this sounds counterintuitive. What would we ideally want? If I invest for 1 year, I should get 5%. If I invest for 2 years, I should get 6%. Which means, as my term for investing increases, logically, intuitively, we would feel that the interest rates on fixed deposits should increase. But what is seen here, this is real data from the Indian market, what is seen here is within a period of 1 month, the yield curve had moved up, and not only had it moved up, the short term had gone more than the 5 year. In essence, what we got, or in effect what we got, was an inverted yield curve, at least in this part of the scenario, and then the yield curve again went up with the 20-year paper rising higher again. Now we need to focus something, because this is very peculiar. Now what happens is, why this happens, what exactly is happening, and what should we make out of this? See, obviously RBI increases interest rates for whatever reasons, to control inflation, to suck out liquidity. For whatever reasons, RBI increases interest rates. Now these are short term rates, which is extremely short term. This is a repo, what we call as. That means when banks borrow from RBI. Now when RBI increases interest rates, and when already interest rates are at so high levels, so when we are talking from 8% going to 9% or 10%, now what is happening is, we have seen here that when interest rates go up, bond investors tend to lose money. Why will bond investors lose, or why will fixed income investors lose? It's very simple. You as an investor, you invested at the rate of 8%, you invested for a period of 10 years, and after you locked your money for 10 years, the interest rates have gone up, so you are going to lose there. Now, if an investor foresees that interest rates are expected to go up, how will he protect himself from this movement? And the answer is, he will crash his paper maturity. That means instead of 10 years paper, he would rather go in for 9 years. Instead of 9 years, he would go for 8 years instead of 8. So that means he would want to invest in as short term bonds as possible. Why short term bonds? Because when rate increases, this part, when rate increases, he will get his money back fast, and that money can then be reinvested at a higher interest rate. So what happens is, when interest rates start going up, bond market participants will like to move away from long term bonds, and they would like to move into short term bonds, primarily for this reason, that because interest rates are rising, if I am invested in short term bonds, at least my losses will be less, because my money will come back to me early, which I can reinvest at a higher interest rate. So therefore what happens is, now this is another concept of bonds which we are talking. So what will happen is, all those investors who have, and this is, we are just talking for, it doesn't exactly happen like this. This is a logical thought process which we are following. What happens is, all those investors who have long term bonds in their portfolio, they start selling those bonds. So when they sell those bonds, their prices go down, and price going down means yield going up. Now this is a very, very important, very, very basic property of bonds, is that bond prices move inversely to interest rates, and this is how exactly it should be said. We should not be saying interest rates are inversely proportional to bond prices. No, interest rates are the independent variable, bond prices are the dependent variable. So when interest rates go up, bond prices come down, and vice versa. So what we are seeing here is, as interest rates go up, people start selling their long term bonds. When people start selling their long term bonds, those bond prices come down, because when you sell something, the price goes down, and when the price goes down, that translates into yields going higher, is what we are seeing here. This is part of the explanation of why we see this. Secondly, if people are exiting these bonds, they must be buying something. So what they buy is, in terms of high inflation, it is observed that the benchmark, which generally is the 10-year paper, typically become the 5 or the 7-year paper. So people start buying the 5-year bond. And when people start buying the 5-year bond, the price of the 5-year bond goes up, which means the yield of the 5-year bond comes down. So therefore we see a scenario when interest rates are high, and high as in significantly high, this is the highest which we have. So the short term interest rates have moved up. Why they have moved up? Because RBI has increased the repo or reverse repo or MSF or whatever, repo, that's the operative one. So short term rates have gone up because of that. Because we are in an high interest rate environment, therefore people want to exit long term bonds, so therefore they are selling their long term bonds. So because of that, the yields of the long term papers go up, and all the activity in the bond markets, or majorly a large part of the activity in the bond markets, gets concentrated in the short term or in the 5-year paper, and therefore we see when interest rates are very high, that the 5-year yield usually comes down, and therefore we see a sort of inverted yield curve type of a structure. What is the economic implication of that? It's very simple. When interest rates are high, no one borrows. Corporates don't borrow for capital expenditure, retailers don't borrow for housing loan, retailers don't borrow for white good purchases. So when interest rates are high, and as in this case very high, 8%, 9%, 10%, when interest rates are this high, it's obviously bad for the economy, look at it any which ways. Why? Because when interest rates are high, nobody is borrowing, so capital expenditure by corporates has come down. When interest rates are high, consumers are not borrowing, so white goods or housing loans, no one's borrowing, so consumption has taken a hit. When interest rates are high, the inflation has to be high, otherwise why will RBI increase so much interest rates so high? So when interest rates are so high, this is typically not the best of interest rate scenarios, and that typically translates into bad economic or slowing of economic activity going forward. So a flat yield curve is a harbinger of economic recession / slowdown. An inverted and a very high yield curve is also a more clear indication that the economy is going to face tough times in the next few quarters. What happens after this is what we will see in the next video. Thank you very much.